What if Florida homeowners could cut thousands of dollars from their property tax bill? But the trade-off? It could affect city budgets, police, parks, roads, and local services. That is the debate happening right now in Florida. And if you own a home, plan to buy, invest in real estate, or relocate to South Florida, this is not just politics. This could affect your monthly payment. Before we dive in, thank you to everyone who has subscribed. If you have commented, if you have shared, if you have supported this channel in any kind of way, thank you. It does truly means a lot to me, and I do appreciate it. This channel is here to help families, home buyers, sellers, investors, just here to just help you make wiser real estate decisions, especially here in South Florida. So if this kind of clear, calm real estate guidance, if it helps you, please go ahead and subscribe, like the video, share with someone who owns a home in Florida, and comment below with your county. Are you in Miami-Dade? Are you in Broward? Are you in Palm Beach? Are you planning to relocate to South Florida? I want to know where you're watching from. So thank you. Now, let's talk real estate. Florida lawmakers approve House Joint Resolution 1F, known as Save Our Homes from Excessive Property Taxes. If voters approve it in November 2026, it would change part of the Florida property tax system beginning January 1st, 2027. Here's a simple version. The amendment would increase the homestead exemption for non-school property taxes. And that means it would not erase every part of your tax bill. That part is important. A lot of people hear property taxes cuts and they think, great, my whole tax bill is disappearing. And that's not exactly what's happening here. Florida property taxes are made up of different pieces. Some go to schools, some go to counties, some go to cities, some go to special districts. This proposal focuses heavily on the non-portion of the property taxes. So the big question is not simply, would taxes go down? But maybe a better question that you need to be asking is, which taxes go down, for whom, when, and what happens next? So let's break it down. If approved, the amendment would increase the homestead exemption to these values that I'm showing here on screen. For example, in 2027, the exception will be to $150,000 for non-school property taxes. Again, this is non-school property taxes. Then on 2028, the exception increases to $250,000 of non-school property taxes. I'm gonna continue saying it. And in 2029 and after that, that exception is being adjusted for inflation again for the non-school property taxes. That is important for you to know. So let's say your home has an assessed value of $400,000. Today, the exception may be reduced for part of your taxable value. So under the new proposed amendments, a larger portion of your homestead value will be shielded from non-school taxes. That could mean real savings, but the savings will depend on your assessed value, your city, your county, your mileage rate, and which part of your bill is school versus which part is non-school. And I'm gonna keep saying non-school because people need to understand, just for the non-school property taxes only. So, for example, if your home is assessed at $400,000, that's the assessed value of your home. Currently, your taxable value might be $350,000. In 2027, that assessed value would be $250,000 of that $400,000. 2028, then that taxable value will be $150,000 $1,000 as that increases. And as I said before, then after 2029, it just increases with the market, essentially with inflation. And that's important for you to know. So lower taxable values generally means lower non-school property taxes. This is why two homes in similar places, similar homes, similar locations may have two completely different tax bills. You know, one may live in an incorporated Miami-Dade, for example. Another one may live in Pinecrest or Homestead or Miramar or Fort Lauderdale. Same state, different local structure, therefore different taxes. Therefore, don't compare it to homes, because your home and somebody else's might be completely different. The biggest potential benefit goes to Florida homeowners with homestead exemption. That means the home is your primary residence, not a second home, not a rental property, not an Airbnb, your primary residence only. Businesses, that's a whole different thing. So this could help long-term homeowners feeling squeezed by rising costs. This would be really good for newer homeowners shocked by their tax bill after their reassessments. This also be great for retirees on fixed income, for families trying to keep monthly housing costs under control, also for first-time home buyers calculating affordability. But there's a key detail for people relocating to Florida. If you're not a permanent resident by December 31st, 2026, the proposal creates a 5-year phasing period before you receive the full expanded exemption. So, if someone is moving from New York, New Jersey, California, or any other state, really, that cutoff might be important. They might not immediately receive the full benefits. That matters for relocation buyers. Should you relocate before that deadline? You might have to reconsider. You might have to consider that. Who knows? Because when you're buying a home, you cannot just ask, what are the taxes today? Now you have to ask, what would the taxes likely be after I buy? What exemptions would I qualify for? And when will I qualify? Now, let's talk about investors, because this is where things get interesting. The homestead exemption is for primary residents, as I said many times over and over. So if you own a rental property, a vacation home, or an investment property, you do not get the same homestead exception. But the amendment also addresses non-homestead properties. Right now, many non-homestead properties have an annual assessed value increase cap of up to 10%. The proposal will reduce that cap to 5% beginning in 2027. And that could help investors, that could help landlords, that could help commercial property owners and second home owners by limiting how quickly the assessed value can rise for tax purposes. But let's be honest, lower tax growth may help investors with predictability. At the same time, local governments may look for ways to replace that lost revenue, and that's important to know. That could show up through fees, service changes, mileage debates, for future tax policy changes. So investors should not only ask, how much do I save, but they should also ask, what happens to insurance and rent and local fees and maintenance costs and city services? Real estate investing is not one number. It is a full picture. Now, here's something many investors, especially new investors, sometimes overlook. A property might bring in $3,500 a month in rent, but rent is not profit. Before you ever see a dollar of cash flow, you still have to pay the mortgage, the property taxes, insurance, HOA fees if you have any, maintenance, and plan for vacancies as well. So in this example, that $3,500 in rental income shrinks to about $350 a month in cash flow. And that's the point. Real estate investing isn't about how much money comes in, it's about how much money stays. So while lower property taxes could certainly help investors, taxes are only one piece of the puzzle. The smarter investors don't focus on rental income alone, they focus on the entire cost, the entire picture, the entire transaction, not just one piece. Now, here's the other side of the story, the coin, the equation. Here's the other side. Cities and counties rely heavily on property tax revenues to fund local services. That includes police, fire rescue, parks, permitting, roads, stormwater management, and local operations. CBS Miami reported that local officials in places like Pinecrest are concerned that smaller municipalities could be hit hard because they may not have large commercial tax bases to offset the loss. And this is where homeowners need wisdom, really, because nobody likes higher tax bill. I don't. I don't know if you do, I doubt it. Most families are already dealing with homeowners insurance and flood insurance and HOA fees and repairs and groceries and school fees and everything else. But we also have to ask practical questions. If revenue drops, what gets cut? If services are reduced, does that affect the quality of life? If infrastructure is delayed, does that affect flooding and roads and neighborhood value? For South Florida, stormwater and flooding are not small issues. They are real homeowner issues, especially in Miami-Dade and Broward. So the conversation has to be bigger than lower taxes good, lower taxes bad. The real conversation is, can Florida give meaningful tax relief while still protecting the services that help community function well? If you're still watching, this is exactly why I created this channel. Because real estate is not just about buying a home, it's about understanding the numbers. It's about knowing the law. It's about understanding the risk and the long-term impact for your family. I am Edwin Cillier, a South Florida realtor, and my goal is to help families build legacy through real estate with clarity, patience, and with wisdom. If you're buying, if you're selling, if you're investing, or if you're relocating to Miami-Dade or Broward, you can visit my site for more guidance or text me directly at 786-774-9077. And if this video is helping you, please subscribe, please share it. Share it with anyone, share it with everyone. But if you know that someone needs to understand what Florida taxes is all about before they make a decision, share this video. I'll appreciate it. Back to the video. Here's something buyers especially need to understand. A homestead exception does not freeze the property's taxes forever or your property's taxes forever. Florida also has Save Our Homes protections, which limit how much the assessed value of a homesteaded property can increase each year. But, however, listen to this. When a home sells, the assessed value can reset. That is why a buyer may look at a seller's current tax bill and think, great, I can afford that, I can pay for that. And then the next year, the buyer gets a much bigger tax bill. What a surprise. This is one of the biggest mistakes buyers make in Florida, especially first-time home buyers, especially people that are relocating, especially people that are moving into South Florida where prices have climbed over the last several years. The lesson here is this. When you buy a home, estimate your future taxes based on your purchase price, not just the seller's current tax bill. This is important. Don't get surprised. If this amendment passes, yes, the exception could help. It will save you. It will save you money. But you still need to run realistic numbers because your mortgage payment is not just principal and interest. Your mortgage payment usually is composed of your principal, your interest, property taxes, homeowners insurance, possibly flood insurance, possibly PMI, possibly HOA. All of that comes out of your pocket every single month. And in South Florida, those last few items can change the whole affordability picture. Let's make this practical. Imagine a family buying a home in South Miami-Dade, in South Florida, Miami-Dade, for $550,000. They're excited, they like the house, the looks, the listing, they love it. The monthly principal and interest, it seems manageable. But then they realize taxes, insurance, flood insurance, they realize it may push the monthly payment much higher than expected. In this case, you add now the amendment into the picture. Could the expanded homestead exemption help? Yes, potentially. Should they buy based only on the hope of a future tax savings? Absolutely not. Please don't do that. Never buy based on a maybe. A wise buyer plans based on what they can afford today, then treat future savings as a blessing, not the foundation of the whole decision. Future savings, you throw it in there to pay that bad boy off. That is how you avoid becoming house poor. That is how you protect your peace. That is how you live in peace within the walls that you buy and don't create or don't make the walls be an uncomfortable place to be. If voters approve this amendment, it could influence the housing market in a few ways. First, some homeowners may feel more comfortable staying in their homes because their tax burden is lower. That could help, keep inventory tight in some areas. Second, some buyers may feel more comfortable purchasing because long-term tax outlook looks better. That could support demand, but again, less people might be selling. So third, cities and counties may be responding differently depending on their budgets. Some may absorb the change, some may adjust services, some may consider fees or millage discussions in order to provide services, in order to pay for those services. For investors, the lower non-homestead exemptions cap could create more predictability. There you go, predictability. And that's a good thing. But again, predictability does not mean risk-free. It does not mean that the risk disappears. Insurance is still a major issue. Maintenance is still real. Tenant risk is still real. Local government's decisions still matter. So my professional opinion is this. This amendment could provide real relief for many homeowners, but it's not a magic wand. It does not fix affordability, not by itself. It does not fix insurance. It does not automatically make every home affordable. And it does not remove the need for careful budgeting. This decision about property taxes reminded me of a principle that Jesus shared in Luke 14:28. He said, "For which of you, desiring to build a tower, does not first sit down and count the cost?" That's exactly what wise homeowners and investors do. They count the cost. They look beyond the headlines, beyond the excitement, and beyond a single number. Whether we're talking about property taxes, insurance, or long-term affordability, wise decisions begin with understanding the full picture. That is real estate wisdom. Do not rush because of headlines. Do not panic because of politics. Do not buy because someone told you taxes might go down. Be diligent, ask questions, run the numbers, seek wise counsel, and make decisions that protect your family, your peace, and your future. As always, here are my actionable takeaways. Number 1, know your exemption. This amendment is expected to go before Florida voters in November of 2026 and would need at least 60% voter approval. Number 2, estimate future taxes. The proposed expanded homestead exemption would apply to non-school property taxes, not necessarily your entire tax bill. Number 3, watch insurance. Primary homeowners may benefit the most, but new Florida residents may face a 5-year phase-in depending on residency, timing, and a bunch of the factors. Number 4, ask questions. Investors may benefit from the proposed non-homestead assessment cap reduction from 10% to 5%, but they still need to watch the full cost and the full picture. Number 5, just plan wisely. If you're buying in South Florida, estimate your future taxes based on your purchase price, not just the seller's current tax bill. Florida property taxes are not simple, but you do not need to be overwhelmed. You just need clarity, that's all. For homeowners, these amendments could mean meaningful relief. Yes. For buyers, it could change affordability. For investors, it could affect long-term planning. And for communities, it raises serious questions about how we fund the services people depend on. So, what you gotta do? Stay informed, stay calm, and make decisions with wisdom, not fear. If you found this helpful, I'm gonna ask you to watch this other video as well that I break down 10 down payments myths that stop people from buying or from investing, because fear stops people from actually just moving in confidence, moving forward in confidence. So I do not watch for you, so go ahead and watch that video. I definitely see you over there. Thank you for watching this video. Remember, God loves you, and so do I. Bye-bye.